Hello and welcome everyone to our The Power of Passive Investing meetup. Matt and I are thrilled to have everyone here. We have a very exciting meetup today. Our guest today is Ted Lanzaro, and the topic is real estate investing tax strategies. So Ted and I go back, I don't know, 5-6 years. I lost track of time, honestly, but it's been a while. We met in New York a while ago at one of the real estate events there. But Ted is a CPA, a certified public accountant. He is a real estate broker. He is also an author, a speaker with over 30 years of tax consulting and investing experience. He runs Landmark CPA Group, which is a boutique CPA firm specializing in accounting and taxation for real estate professionals. For the past 30 years, he's helped thousands of real estate business owners, entrepreneurs, and investors all over the United States to implement cutting-edge tax strategies that save them thousands of dollars on annual taxes. Ted is the author of Tax Smart Landlord, as well as over 100 articles on taxation for the real estate industry, specifically for investors, syndicators, and developers. Ted is a sought-after speaker and had spoken all over the United States to groups of real estate investors and business owners on taxations and real estate. And Ted just mentioned to me that he's going to be at yet another real estate conference in June in North Carolina, and I'll let Ted to take over the floor in a few minutes and share a little bit more about that conference for those that are interested. So as usual, this presentation is for educational purposes only. We're not selling anything, not offering securities. Please consult your own CPAs and attorneys for specific offerings. And as well as housekeeping, please keep yourself on mute for the time being. Once the presentation is over, feel free to unmute yourself to ask a question, or feel free to post your questions in the chat and I'll ask them on your behalf. We'd love to connect with you. Matt and I are both co-hosting this meetup. This is our contact information. Feel free to reach out if you have any questions or just want to have a conversation or have any ideas for either presenters or how to improve future events. We always welcome feedback. So, and thank you very much for being part of our group. Let's see. And so this is again our topic for tonight with the 3 main bullet points of what's going to be covered. And without any further ado, Ted, why don't you take the floor?
Okay, so if you don't mind, if did you give me share?
I have.
Okay, so let me see if I can get my little presentation going here, and I'll just start with this, and then I'll pull it down when I.
We can see the Ted. So yeah, please go ahead.
Okay, so going to slideshow. Okay, so this is what, so Alina and Matt, thank you so much for having me on tonight. I really do appreciate it. So tonight we're going to discuss the things that Alina was just showing on the screen. We're going to talk about how to take a proactive approach to your taxes. So many people are reactive with their taxes. They just like literally show up at their CPA's office, April 10th, with their documents, and they, hey, save me some money. Most tax savings happens during the year. So I actually run a program. My program for clients is called year-round tax planning. So it's a very strategic and proactive approach, and we'll talk about how that can save you quite a bit of money during the year. We're going to talk about the tax advantages of investing passively, and why would you want to invest passively. We're going to talk about the types of investors whether they be passive, active, or real estate professional, and how those affect your taxes. We're going to talk about tax strategies for passive investors, people who are W-2 employees and business owners, and then we'll have just open question time. You can ask me whatever you want. So let's start with this premise. I'm looking at the thing. There's about 16 people on the call. Every single one of us is different. Okay, and part of proactively planning for your taxes is understanding that everybody is different and that the approach has to be tailored to your individual situation. So some of you may be W-2 employees, some of you might be business owners, some of you might be business owners in the real estate space, and that would make a big difference. If you're a landlord, if you have your own properties, that makes a difference. Married versus single makes a difference. How much your income is. The IRS phases out certain deductions at certain income levels. The IRS also has surtaxes on various types of income based on your income level. You have to know and understand these things, right? That's part of taking a proactive approach. What are your goals and limitations? I was having a conversation today with somebody who literally could have gotten their taxes down to zero, but they would not have gotten a loan that they're trying to apply for. So they literally asked me to leave some deductions off so they'd have more income to show. How many properties do you have? That's another factor. And what kind of investor are you? A passive investor, an active investor, or do you qualify as a real estate professional? So what does it mean to take a proactive approach? Well, in my scenario, what I deal with, I literally, this is all I do. I strictly do tax consulting, tax strategy, tax preparation for real estate investors, right? So I tell my real estate investor clients, I want to know whenever you're planning to buy a property, sell a property, and renovate a property, and any other major thing that has to do with your income or deductions, I want to hear from you. And when I say I want to hear from you before you buy a property, I mean before you buy a property, right? Like when you put it under contract, right? I don't want to hear from, if you're selling a property, I don't want to hear from you in April that you sold the property last July, right? I can't really do too much with that, right? But if you call me and say, like I had a guy call me today, it's like, I just got an offer on an apartment building I own. I'm going to have a huge gain. What can I do to offset that? Should I even sell? Right? I got the same email from 2 different clients today, right? Basically. So those are the kind of things. Why? Because if you're going to sell a property and have a huge gain, well, you better have a plan in place during the year to be able to offset those taxes, right? Why? So let's say, just as an example, when I'm talking with somebody like that who's about to sell a property, I can say, look, here are the things that are available. You can do a 1031 exchange. We'll talk a little bit about that. You can use cost segregation and bonus depreciation on a new property you purchase, even if you don't do an exchange, to offset the gain, right? So we're putting things in place during the year to help offset the things that are happening during the year, not in April after the year is over, but literally during the year, right? We're communicating, we're asking questions, we're finding out, hey, how much income did you have this year, right? One of the things with almost all of my clients is we're talking all during the year about how much money they're making, right? Why? That's important to know, right? Timing of events. Timing is everything. You know that expression, timing is everything, right? Well, with taxes, it really is everything, right? So if you sell a property in December, and trying to offset it with depreciation on a property you bought in January, that doesn't work, right? You've got to match up the years. So that's what it really means to take a proactive approach. Planning during the year. The other part of being proactive is making sure that you have the necessary documentation in place to justify all the things that you want to do, right? So just give you an example. Somebody says to me, we're going to renovate a property, right? Okay, great. Here's the record keeping steps that I want you to take, right? So if you're going to renovate a property, just as an example, I'm going to want you to take before pictures, right? Why? Because all the things that are not there that were there in the before pictures that aren't there in the after pictures are probably a tax deduction. You threw them away. You paid for them when you bought. But okay, so why would we want to invest passively well, one of the reasons is that you can be involved in bigger deals than you have the knowledge to be able to do, right? So I've been a real estate investor for 30 years. I started buying single family homes and renting them out. Why? It was easy, right? You don't have to have a lot of specific market knowledge to be able to do that, right? I got involved in apartment buildings. A little more knowledge required, right? Property management knowledge, stuff that is more intensive, right? And now with the kind of, fast forward 30 years, now with the kind of properties that people are getting involved in buying now that you would invest in passively, these might be 200 units, 100 units, 300 units, right? Not only do you need to know how to manage them, right? But in a lot of cases, you need to have a business plan in order to maximize the value of them, right? Because that's what a lot of this is all about. A lot of what the passive investors are doing, or a lot of what the active investors who are taking in passive investors are doing, is they're buying, fixing up, implementing a business plan that raises rents, implementing services that add income, doing all of these things that add value to the property. Because you have to remember that every time big properties are valued based on the income. The more income you have, the more valuable property is, right? The other thing about passive investing is, so you don't have to have specialized knowledge. You can rely on the operator to have that knowledge. You can invest without dedicating a lot of your time. You want to do some due diligence on the person you're investing with, and you want to understand what you're investing in, but you don't have to spend the 1,000 hours it takes to find a property. You don't have to fly to 10 different places to look at 10 different properties to see if this one's worth buying, that one's worth buying. You don't have to do the due diligence. You don't have to do the inspections. You don't have to deal with the financing. So there's a whole bunch of time-saving elements for investing passively. But the biggest reason to invest passively is tax-free cash flow. Okay. And what tax-free cash flow is this is why people are in the real estate business to start with, right? The reason there are real estate investors is because the IRS tax laws say that you can use depreciation expense to offset the cash flow of the property, the income of the property. So what you end up with is dollars in your pocket, but no taxable income. And I'm going to show you how you do that in just a second. So this is how tax-free cash flow works. The property, you own the property, right? And this is whether or not you're invested passively or whether you own the property yourself, right? You collect the rents, you pay the bills, right? What's left is your cash flow, right? So you're allowed to use depreciation expense to offset that cash flow. Depreciation is nothing more than the rational allocation of the purchase price of the property over a period of years. And the IRS uses 27.5 years for residential properties and 39 years for commercial properties, right? It also allows investors to break out all of the 5 and 15-year properties and deduct it in year one, right? So what does that effectively mean, right? Well, 5-year property in an apartment building is everything you could literally unscrew, unplug, disconnect, and walk out of the apartment with. So it's all of your appliances, it's your kitchen cabinets, it's the vanities and mirrors and lighting, toilets, all of those things. And typically that runs about 18% of, now on national average, it runs about 18% of the cost of the property, right? On the 15-year property or is what's called land improvements. And land improvements are the parking lot, the fencing, the retaining walls, the sidewalks, right? All of the landscaping, right? Those things are all can all be depreciated over 15 years and based on current IRS law, all deducted in year one, right? So think about this. If I'm a high net worth or high income individual, a high earning professional, and I make $500,000 of earned income, and I pay $200,000 in taxes during the year, federal and state, and that's not far-fetched if you live in any of the high tax states like New York, New Jersey, Connecticut, Massachusetts, California, right? That's where a lot of these high paying jobs are. So that's where a lot of people live. So you might be paying tax at 40%, right? Now, even if I can't take all of the tax deductions, even if I'm not a real estate professional and I can't literally apply the huge loss I may get on my K1 against my ordinary income, by adding about $100,000 a year of passive income to my portfolio by investing passively in syndications, I can effectively bring my my tax rate. So if I pay $200,000 in taxes on 500, but now I add another 100, so now I have $600,000 worth of actual cash flow dollars I've earned. I'm still paying $200,000 in taxes, but my effective tax rate is now down to 33%. That's the magic of tax-free cash flow, and that's the magic of passive investing. It's earning extra money that you don't have to pay taxes on. So let's talk a little bit about the types of real estate investors that exist. These are IRS categories, and the categories are basically, I'll explain to you what the category is and what the tax ramifications of being in that category are. So a passive investor is anyone who invests in somebody else's deal. They're investing for a return on their investment, a cash return on their investment. Typically, they're going to get a cash return, on a monthly, quarterly, annual basis. And they're also going to possibly have a piece of the back end when the property is sold, okay? But they don't have any management control. They're not decisions. They're literally investing their money for a return on their investment, right? If you're a passive investor, you're not allowed to deduct rental losses against your ordinary income, okay? You don't lose those rental losses. Those losses carry over on your tax return until one of a handful of things happens. You either have passive income to offset it, or you use it to offset other net rental income that you have, or you use it to offset other capital gains from rental properties that you have, or when the property sells that you're invested in, you get to deduct those carryovers against the gain on the sale that you have. Okay, so you never lose it. It's just a matter of timing when you ultimately get to take it. Okay, but in the meantime, you're getting a check every month, quarter, year that you don't have to pay taxes on. An active investor is somebody who owns and manages their own properties, okay? What the IRS says is if I'm an active investor and I earn less than $150,000 a year in ordinary income, I'm allowed to deduct up to $25,000 a year against my earned income in rental losses. So if you make $100,000 a year and you own a couple of rental properties and your rental loss is $25,000, you only have to you pay tax on $75,000, the $100,000 you earn from your job less the $25,000 loss you have in your rental properties. Now that's not an actual loss. You may literally have cash flow from those rental properties in your pocket, but the depreciation expense that you took, the rational allocation of the purchase price that offset it, created the tax loss that allows you to offset against your ordinary income. So it's a really valuable part of real estate investing. The third category, real estate professional, is sort of the holy grail of real estate investing. What that means is that you work or own a real estate business that you spend more than 750 hours a year running, okay? And it has to be more than half of what you do, okay? So if you have a full-time W-2 job, right, where you're working 40 hours a week plus, 52 weeks a year, you're putting in 2,080 hours, having 750 real estate hours doesn't help you. Why? Because it needs to be more than half of what you do, okay? So you'd have to have literally 2,081 real estate hours. Next to impossible to do if you actually want to try to get at least 4 or 5 hours sleep a night, right? So real estate professionals are allowed to deduct unlimited rental losses against their ordinary income. So who gets to do this, right? So I've got a client who's a real estate broker, right? And so this is all he does. He puts way more than 750 hours in, and he doesn't do anything else. So it's definitely more than half of what he does. He sold a few properties this past year, and he had commissions of about $600,000, right? So during the year-round tax planning, during the year, I said to him, you know what? You should go and buy another apartment building. Why do I need to do that? Well, because you can take the bonus depreciation on the apartment building, do a cost segregation study, take the bonus depreciation on the apartment building and offset the income. Hey, that sounds like a great idea. So he went and bought an apartment building. A couple months later, he calls me. He's like, yeah, I went and bought $1 million apartment building. Let's do a cost segregation study. So I hooked him up with the engineering firm that does the study, and he ends up getting $200,000 of bonus depreciation from the study, right? Well, now he can apply that $200,000 depreciation loss, not cash out of his pocket, depreciation loss, rational allocation of the purchase price of the property against his $600,000 income, and only pay $400,000 in tax. He only has to pay taxes on $400,000, right? If he's in the 40% tax bracket, that's $200,000. That's an $80,000 tax savings, right? $200,000 times 40%. So that's really the magic of being able to have real estate professional status. But again, that's not everybody's going to be able to do that. So I'm gonna just we're in a time crunch. So I'm gonna skip over this. So whenever you're a passive investor, right? This is just an example. This is somebody's K1, right? This is what you're gonna get if you're a passive investor. At the end of the year, you put your money in. Now look, this person has $4,000 of cash they got during the year on this one investment, but they have an $8,000 tax loss, right? So this cash that they received is tax-free. They don't have to pay tax on that. Now, what if you had 10 of these kind of investments, right? You would have gotten $40,000 in distributions during the year, but you'd have a net tax loss. This is the number that goes on your return, right? So there's no tax due on that money. That's the power. Building a stream of these things is how you leverage the power of passive investing. Okay. So let's talk about some tax strategies for passive investors. Even if you're a passive investor and you can't deduct the rental losses against your ordinary income, there's still stuff you can do that'll help you save money, right? So let's go back to this. Let's say, just as an example, you took this $4,000 that you got tax-free from your K1 distribution and you stuck it in a retirement plan, right? Maybe you put it in an IRA. I wasn't able to deduct the $8,000 on the K1, but I can use that cash that I got, that $4,000, to offset my earned income from work by making an IRA contribution, right? Okay. So, and if I have a stream of these, let's say I had 10 of these, right? Well, now I could use that. Let's say I'm not maxing out my 401k at work, right? Well, now I take that stream of income that I'm getting, right? And I use it to fund my retirement plan at work. In other words, I allow my boss to put money away in my 401k, and then I live on the extra cash flow I'm getting from my investments. What did I do? Oh, I mean, if I max out my 401k at $20,000 a year, I've created a $20,000 deferral, even if I didn't get to deduct the rental loss on the K1, right? I'm just using the cash flow that I'm receiving from my passive investments to create tax deferrals. I can do the exact same thing if I own a business, right? So even if I don't own a real estate business, but I'm using my profits from my business to invest in passive investments and building up this stream of cash flow, right? And let's say I've got 10 of these things, I'm getting $40,000 a year. Well, I can use that money to put in my business retirement plan. And now I'm deferring $40,000 of my business income, not deducting rental losses, but I'm using the cash flow in such a way that I'm creating a tax deduction. So now I'm reducing my business income by making a retirement plan contribution, and I'm allowing that money to grow tax-free until the time I retire, right? So this is a huge, this could be a huge benefit, right? I can also use, so let's go back to the K1. Let's say I had $8,000. Let's say I owned a rental property and that another rental property or a series of rental properties, and I had $10,000 of net rental income that I had to pay taxes on during the year. Now I can use this rental loss to offset that net rental income, right? So I know a lot of people who invest in syndications just because they have a whole bunch of mature rental properties. They've already used all the depreciation on their active rental properties, so they use the syndication losses to offset that net rental income. It's a great strategy, right? The other thing we do is we build up your passive loss carryovers. Remember, we were talking about passive loss carryovers are the losses you can't take that add up year to year, right? Well, I go around and I tell people, look, if you're actively searching out passive investing opportunities and spending money searching out passive investing opportunities, you can deduct those amounts against the K1, in addition to the K1 losses you're incurring. Why would I want to do that? I want to build up my passive loss carryovers, right? So if I got a $10,000 loss every year through my K1 on my passive investments, and then I deducted an extra $2,000 a year in miscellaneous travel and meals and office supplies and a portion of my cell phone and a portion of my internet because I'm using all of these things to search out passive deals, right? Well, now what did I do? I deducted an extra $2,000 a year for 5 years. I've got a $10,000 additional loss carryover than I would have had if I didn't do anything, right? Now that's $10,000 more capital gain I don't have to pay tax on when they sell the property, right? So it's not an immediate, hey, I get this immediate tax benefit in year one, but it's more of a longer term approach to maximizing the tax benefits of things you're spending money on anyway. And that's what it's all about. All I'm doing is converting things I'm spending money on already into deductions and then just adding it to my past losses. The other thing you can do is you can use your IRA to invest in syndications, right? So if you've got IRA money available, you can put that money into syndications. And then the thing that happens is you don't worry about this number. All you're investing is for this number. This person looks like they put about 50 grand in. I put my $50,000 in, I get my $4,000 every year, right? So now my IRA account increases by $4,000 a year, tax-free, right? The money is growing tax-free. If I've got a Roth IRA, when I go to take that money out, I'm not paying any taxes on it, right? A traditional IRA, the money you earned during the period of time, you deduct it at the beginning, you take a tax deduction when you put the money into the IRA, and you have to pay taxes on the money as you take it out. In a Roth IRA, you don't deduct the money going in, so you don't have to pay the taxes going out. So this is a great way of growing your IRA, right, and investing tax-free in real estate. So what I do for a living is customized. I mentioned this earlier, customized tailored tax plan, right? And there's a bunch of steps to that, but it's basically amounts to understanding each person's situation and developing a plan that's tailored specifically to help them minimize their taxes. So I know I went a little more than a half hour. I added in a few minutes for the real estate appraisal we did online tonight for that gentleman. And so now we can just take questions. So I'm gonna stop my sharing now so we just talk to you guys.
Thank you so much. And again, sorry for the early interruption. I'll let folks either unmute themselves or post questions in the chat, and I'll start with the question. So what you mentioned earlier, that you can take your passive losses and offset your passive gains. Let's say someone has a slightly different situation where they used to be passive and they accumulated a number of passive losses that you can carry forward, but now this year or last year, whatever, the person became active and they are claiming real estate professional status. What happens with all those prior passive losses?
In certain situations, you're allowed to use all of those passive losses if you qualify for real estate professional status and you're active in a deal, you can use the prior passive losses from that deal.
Mm-hmm.
You can take you still have to go by the criteria that, yes, I qualify as a real estate professional, but now I can only use the prior carryovers that relate to the deal that I'm active in. I can't take all my passive investments and use all of that loss to offset my earned income, but I certainly can use the losses from the deal that I'm active in.
So essentially, the rest of your losses remains being carried forward until the project goes full cycle, and then you can offset your gains since you're
right. Yeah, exactly. Or you end up having rental income from some other source, or you have a big capital gain from a sale of one of the syndications. So if you have a capital gain from one of your, let's say you're in a whole bunch of syndications and you have a capital gain on one, you can offset, you can use your losses from any other deal to offset the capital gain from one.
So you could be active professional, but still have some gains that qualified as passive gains and would allow you to offset your carry forward prior passive losses. Is that what you're saying?
No, what I'm saying is that anytime I have a real estate related capital gain from the sale of investment real estate, I can passive losses from anywhere, even if I'm a passive investor, to offset that capital gain.
Even if you're claiming real estate professional in a particular year.
Even if you're claiming real estate professional, but you don't have to claim real estate professional, you can just be passive.
Got it. Okay, thank you. I see one question in the chat. Do you have to pay back the 25% tax on depreciation down the road when using the bonus depreciation cost segregation strategy?
Yes. Yeah, it's a tax deferral, right? So you're definitely going to pay it back, right? But think about this, right? So it's a tax deferral. Now, the maximum rate is 25%. So if I'm in the 40% bracket, right? Okay, I'm saving at 40 and giving back at 25. So I've got essentially a 15% spread, right? Plus I've got probably a 5-year deferral. So that's where, so yes, you're giving the money back 5 years later, but you're giving it back at a lower percentage, and you're giving it back 5 years later with money that's probably worth 5 years worth of inflation less than it was worth, when you put it in.
Excellent, thank you, Ted. And I'll just share what happened in one of our projects. Is we did the cost segregation study on a apartment building, and then after that the building was renovated. So some of the items that were part of the cost segregation study were no longer part of the building. We replaced doors, windows, and so forth. So if these items no longer belong to your property, you're not paying depreciation recapture tax. That's what this tax is called. So we only paid the depreciation recapture on the pieces of the property that were still part of the property. So it was on a much smaller sum than we initially did the cost segregation on.
Yeah, perfect.
Thank you. It's called depreciation recapture tax. And folks, I'll type for those that are interested. Someone is asking me privately. So I'll type it in the chat if you want to look it up. Guys, feel free to unmute yourself and ask questions.
I have a question.
Go ahead.
I didn't really know how to type this question, nor do I know if it applies necessarily, but there was one year where, so I have a W-2, and then I also own property and run it. And I definitely spend more than 750 hours. But when I asked my accountant, because I was trying to figure out how to take the passive losses against my active income, when I asked if I could apply it and say that I may have been arguing that I was I was in real estate, and that I didn't realize there was like a way to be an active investor. But he said that when he submitted the taxes, all it showed was that he would check a box, and then all of a sudden it would get flagged and go to someone's desk, and I was more likely to get audited because I had not been doing it. I think that was the reason. And so I'm trying to understand, is there a way to take advantage of this, but still stay away from triggering anything where the IRS might do more due diligence? And I think his concern was that I'd always reported just regular W-2 and never that I was an active investor or real estate professional, even though I do it on the side. Anyway, hopefully you get what I'm trying to say.
Okay, yeah, no, I got it. Yeah, I got. So how many hours do you work your W-2 job?
So I don't know. It's definitely a full-time job, but it's not like I show up 9 to 5. It's like it's a surgery schedule. So I'll work certain days of the week. But on the same flip side, I will spend just as much, if not more, depending on how high or low business is working
Okay. Are you a doctor? You're a surgeon?
inside of things.
Your voice is coming in and out, Evan.
Oh, sorry. Yeah, so it's hard for me to say because I have a lot of flexibility with my W-2 job.
Okay.
So yeah.
So here's what I'm thinking, right? Is that more than likely, right? See, the problem that you have, okay, is that anybody who has a W-2 job trying to qualify for a real estate professional status has to get over the more than 50% hurdle, right? So it's not enough to have 750 hours because even if you have a flexible schedule and you're working 1,500 hours a year, maybe you're not working 2,000 plus hours. Let's say you're working 1,500 hours. Well, now you got to have over 1,500 real estate hours, right?
So I will never do that. And I guess so now my question is, because if that's the point, then I need to get a different job. But how do I take advantage of the active investor thing? Because being able to deduct that 25K against earned income would be a huge value.
Right. Okay. So what I failed to mention during the presentation was that the IRS, remember I did mention that the IRS phases certain things out based on income at the beginning of the presentation. I was saying, income matters, right?
Yes, after 150, yeah.
After 150, it phases out, right? So when your scenario, right, you probably don't qualify for that. I'm not gonna get into your income and stuff on call 20 people, but let's assume that you don't qualify for that, right? So you probably aren't able to use the active investment. So you're in a situation where even though you might be actively managed, so you're kind of like me, right? I don't actively manage properties anymore. The reason is because I there's no point to it. I don't get any tax benefit from managing properties, calling myself active because I earn more than the $150,000, phase out amount, right? So, so you're essentially an active passive investor, if that makes any sense, right? Because you might be actively managing your properties, but you're treated like a passive investor because you're phased out of those.
I see.
So the only thing you can do is continue to try to build up as much cash flow as you can. The more cash flow that you have, the lower your marginal tax rate will be. Does that make sense?
Okay. Yeah, that does make sense. And although I got lucky the past few years and I wouldn't qualify, this year's taken such a precipitous plunge. The reason why your thing intrigued me is that, maybe I would qualify. And then I guess it's just a matter of citing it appropriately in my tax forms. Since like I should fall within the qualifications, but you don't think that will trigger anything. It's just a matter of doing the paperwork properly.
Yeah. And look, here's the thing. So what I would tell you in that scenario is start keeping a time log. I tell all my real estate anybody who wants to try to qualify for real estate professional status has to keep a real estate business time log, and it's got the more detailed it is, the better off you are. And there's a whole I do an hour consultation on how to do it, literally, But
okay, would that same apply to you as an active investor?
Yeah, yeah, you do. You would still, it's not as onerous as the real estate professional one would be. But yeah, you should definitely be tracking your active, the time that you spend actively, right?
Basically, you do a time card for yourself for what you're doing, and then that's how you track, record, and prove. Okay, all right, great. Well, thank you
Yeah,
so much. I didn't mean to take so much time with the question, but it's always been confusing to me, so I appreciate your answer.
yeah. And Evan, one more thing is, I not only would I keep it like a timed log, but I'm also keeping, if I go out and meet with a broker, I'm getting a business card. I go out and look at a property, I'm taking pictures, right? So I'm creating a file of all the
I
back
see.
of the things that I say I'm doing.
Right.
Because when the
Okay,
time comes
perfect.
for audit, it will come very handy, just in case.
Right.
Yeah, no, that's great. Thank you.
Yeah, great question, Evan. Thanks for asking. Folks, again, feel free to unmute yourself and ask questions. While we're waiting for questions, Ted, why don't you share your contact information in case someone wants to reach out to you? If you want to post it or just type it in the chat, whatever is easier for you.
Yeah, okay, so I'm going to actually,
And Wayne, I see you typed a comment. Did you want to ask a question in regards to that? Excellent. Thanks for sharing, Ted. Ted, do you want to share the conference where you're going to be presenting with everyone?
yeah, so that's a good idea. So there's a multifamily conference that's happening in Charlotte, North Carolina. The dates of that conference are June 23rd to 25th. That's a Thursday through Saturday. And it's going to be a whole group of multifamily specialists that are going to be speaking at the conference, and also guest celebrity speakers. Jocko Willings, who's an author, a former Navy SEAL, who wrote a book called Extreme Leadership. He'll be one of the guest speakers. Barbara Corcoran, the real estate entrepreneur who's also a Shark Tank person. She'll be speaking at the event. And Shaquille O'Neal, the gigantic basketball player, will be from an NBA star, will be speaking at the event.
Sounds exciting. Thanks for sharing. This is good. Folks, any other questions that you want to ask Ted? That's
It's called the MFIN conference, MFIN. So you can, I'll put it in the chat if you're interested. You can go. It's mfincon.com.
So it's probably multifamilyinvestornation.com, I'm guessing.
Conference.com, right? Yeah, and if you're interested, email me and I'll send you the link, because I actually have like a, what do you call it, like a $200 off link you can use. Type a landmark into the thing and you get a discount.
Excellent. Great. Thank you for sharing, Ted. Very nice.
Do you do personal consult sessions? I don't think I'm in a position where I want to switch accountants, but I feel like mine isn't exactly 100% a real estate accountant, and I'm worried that I might be missing some tax strategies. And I would be interested if you provided like a 1-hour consult session that you just pay for to just have a conversation.
Yeah, I mean, I do that as time allows me to do it. I'm typically pretty busy, but if you send me an email using the contact, I will try to accommodate that, you know.
Okay.
And if we can kind of connect on our schedules, then I'm always happy to do that. And honestly, I think like somebody in your situation, so what I would do, just so everybody knows, like, and you can all do the same thing. And I'll accommodate as many people as I can. What I typically would do is I would ask you to send me a copy of your prepared tax return, last 2 years or something. And then I would take a look at it, and then we would get on the phone and talk, and I would tell you what I see, where I think you can improve, what I think you're missing, blah, blah, blah. Or I might say, hey, Evan, you've got a great tax preparer. It looks like they're doing everything they could possibly do for you. And just, be happy.
Just reassurance. Okay, perfect. Well, thank you. I'll reach out via email.
Okay.
I don't hear any more questions. So Ted, thank you so much. This was very helpful. Sounds like you've answered a lot of questions up front. And folks, if you want to reach out, Ted's information is in the chat. The session has been recorded, so probably later tomorrow, I will send the recording to everyone if you want to re-listen to the presentation that may answer some of your questions. And just feel free to reach out to Ted for any real estate related questions. Thank you so much again, Ted. Appreciate it.
Hey,
Thank you.
Matt, thank you both guys for hosting this, and I appreciate it. Have a great night.
Have a good night, everyone. Bye-bye.